So let's dive in and let's discuss the key focus of financial accounting and how it relates to our financial statements. The key focus of a financial statement is to provide financial information to our external users, such as investors. They're the shareholders who are willing to invest in your company, creditors, which are the banks and other lenders who are willing to lend you money, and also outside parties such as customers and suppliers and possibly even government agencies. There are four types of financial statements that we need to be cognizant of. First of all, the income statement and its related statement of comprehensive income. Also, the statement of stockholders' equity, the balance sheet, and lastly, the statement of cash flows. Kind of an overlooked statement, but very important nonetheless. We'll discuss each of these statements in much more detail later in the course. But first, let's discuss why investors and creditors are willing to provide us capital. They're basically looking to earn a fair return. On the very next slide, we'll review a rate of return example. Also, our investors and shareholders want two things when they invest in our company: periodic dividends, kind of a stable return, as well as an increase in the market or share price based on our stock markets. So let's take a real quick review of a rate of return calculation example. Go ahead and read the information related to this investment. I'll give you a minute to calculate his rate of return. Does everyone think they have it? I'm going to move over to the whiteboard now to illustrate how we would calculate the rate of return in this particular example. Okay, we want to talk about a rate of return example. So let's say you make an investment in Apple stock of $1,000 on January 1st. During the year, Apple gives you dividends of $50. Okay, so far so good. At the end of the year, you sell this investment for $1,050. We have all the pieces. Let's figure out what our rate of return or return on investment is. So our ROI would be the $50 of dividends that we got throughout the year, plus the $50 gain that we sold the investment for at the end of the year, divided by the original investment. Thus, it's 100 over the 1,000. And basically, our ROI in this example is 10%. Now, again, I think we'd all understand that's a very healthy return. We'd be very happy with that if we could get 10% on all our investments. And that, folks, is how you calculate rate of return. Hopefully that example was helpful. But the bottom line is that investors and creditors prefer to invest in stocks and bonds that provide a very high expected rate of return relative to risk. It's that often talked about risk-return analysis.